Well, let's just get right into it, shall we? If you've been glancing at your portfolio lately, you've probably noticed the stock market has been, well, completely stagnant. It's basically flatlined for what feels like an eternity, handing us practically zero returns. But, and here's the crazy part, if you look away from your trading app and just glance at the news, the contrast is absolutely jarring. We're seeing these massive, anxiety-inducing global economic warnings literally flashing red everywhere. So in this explainer, we're going to bridge that massive gap. We'll break down exactly what is happening out there in the global macroeconomic landscape right now, and much more importantly, how it directly impacts the micro-level decisions you're making with your own hard-earned investments. To truly wrap our heads around the gravity of the situation, we've got to start with a severe warning recently delivered by Prime Minister Narendra Modi during his visit to the Netherlands. He directed this message to the entire world. And guys, the stakes could not be higher. He explicitly stated that if the current global conflicts don't stop quickly, we are going to wipe out 10 years of economic progress and face a massive return of poverty. He's literally warning us of a decade of disaster. So here is our roadmap for this explainer. We'll start with the decade of disaster warning, then look at rising global geopolitical tensions, move into the double economic shock, unpack India's macro defense strategy, and finally, talk about navigating your own stock portfolio. All right, Section 1, the decade of disaster warning. So what the Prime Minister is really pointing out here is that a prolonged state of conflict doesn't just mean global growth takes a little pause. No, it means an active, devastating regression. We're staring down a scenario where global supply chains, which, let's be honest, are already pretty fractured, could break down entirely. Economically speaking, we'd be pushed all the way back to the year 2016. Every bit of achievement from the last decade would just be completely wiped out. And honestly, the most heartbreaking part of this data is the human cost. Millions of people who successfully fought their way above the poverty line over the last 10 years would be dragged right back below it. It's a really stark, terrifying assessment of exactly where the global economy is teetering right now. Moving on to Section 2, rising global geopolitical tensions. Now, you know as well as I do that markets absolutely hate uncertainty. And right now, political maneuvering is injecting massive amounts of it into the system. Just as an example, former U.S. President Donald Trump recently posted a highly provocative image on his Truth Social platform. It featured a map of the Gulf region heavily overlaid with U.S. flags and explosive imagery directed at Iran from literally all sides. Now, regardless of the political intent behind it, we're not getting into that. From a strictly economic perspective, this kind of imagery acts as a massive catalyst for volatility. It essentially telegraphs the threat of immediate escalation. And let me tell you, this kind of unpredictability absolutely shatters bullish market confidence. Because think about it, nobody wants to buy aggressively when the threat of an escalating regional war is being broadcasted right on social media. This brings us to a concept that is absolutely crucial for any investor to understand: geopolitical risk. Essentially, it's the threat that political decisions, posturing, or instability in a specific region are going to spill over and negatively impact international relations, choke off supply chains, and ultimately crush your investment returns. When leaders issue threats or post explosive maps online, that translates directly into fear on the trading floor. It's a straight line from geopolitical tension to market panic. Which leads us perfectly into Section 3, the double economic shock. Okay. Here is the first half of that shock. Because of these ongoing tensions and frankly the total lack of any positive news regarding peace, crude oil prices are surging. We're talking about crossing the incredibly dangerous threshold of $110 per barrel. And for an economy that relies heavily on importing oil, having prices at this level is an absolute nightmare scenario. And immediately compounding that pain is the second shock, the currency crisis. The Indian rupee has been plummeting, hitting historic all-time lows and actually crossing 96 against the US dollar. Some experts are even out there warning it could slip to 100, or in a worst-case scenario, much higher if drastic measures aren't taken. Put those two things together and you've got a lethal combination for the national wallet. Let's actually walk through the math to see exactly why this is so lethal. Let's compare the previous environment to our current crisis environment. India requires roughly 50 lakh, or 5 million barrels of oil every single day, right? Previously, with oil at $60 and the dollar at 70 rupees, our daily bill was around 2,100 crore rupees. Fast forward to today, oil is at $110, the dollar is 96 rupees, and that exact same daily requirement now costs a staggering 5,280 crore rupees. Let that sink in.
So, the absolutely crucial point here is that massive number, a 151% jump in the country's daily oil bill. This isn't just some abstract number on an Excel spreadsheet. This is national wealth bleeding out every single day. Multiply that extra 3,180 crore daily loss by 30 days or by 365 days, and you immediately see the sheer scale of the economic disaster. And this triggers a brutal domino effect. Think about it. Expensive oil makes transportation more expensive, which drives up inflation across all goods, which forces the central bank to hike interest rates, and all of that ultimately traps the stock market in a stagnant downward cycle. It's all connected.
Okay, Section 4, India's Macro Defense Strategy.
Now, the government isn't just sitting idle. They are actively deploying countermeasures to survive this. The overarching strategy here is decoupling from singular vulnerabilities. First off, they're forging diverse, solid global partnerships, like the massive tie-ups with the UAE and the Netherlands, so we aren't completely reliant on just one bloc. Second, there's a heavy emphasis on vocal for local to really boost our domestic manufacturing. Third, they're accelerating the shift toward clean energy so we can eventually escape this trap of imported crude oil entirely. And finally, an overall prioritization of extreme economic self-reliance. It is a vital, long-term survival plan for the country's economy.
Which brings us to our final part. Section 5, Navigating Your Stock Portfolio. I want you to look at the contrast here. You've got the tangled, chaotic movements of the broad index on the left versus the focused, granular growth of an individual business on the right. When the news is terrifying and the market is flat for 2 straight years, human instinct just screams at you to liquidate your entire portfolio. I get it. But you have to separate the broad index, like the Nifty or the Sensex, from the individual businesses you actually own. Listen, basing your buy or sell decisions for your specific portfolio on what the broad index is doing is a guaranteed way to destroy your wealth. We actually call this the Nifty paradox. Think about it for a second. Historically, the Nifty has soared from 5,000 all the way to nearly 25,000. But during that massive run-up, plenty of bad companies still went bankrupt and got delisted. On the flip side, right now, even with the broad index largely stalling and offering practically zero returns over the last 2 years, there are genuinely strong, future-oriented businesses hitting all-time highs. If a company has great fundamentals and a thriving business model, it really doesn't matter if the Nifty is flat. Good companies are going to make you money regardless of the index, and bad companies are going to lose your money even in the middle of a massive bull run. So as we wrap up this explainer, I want to leave you with this thought. Instead of letting scary global headlines dictate your emotions, look inward at your assets. Stop asking what the Nifty is going to do tomorrow. The real question you absolutely must ask yourself today is this. The index might stall, but are the specific companies in your portfolio built to survive the shock? If they are, you have nothing to fear. But if they aren't, well, then it's probably time to do your homework.